The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
More evidence of cooling inflation was all the markets needed to resume that rally. From Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Deal. Highs of the session here as we head into CPI Wednesday.
All it took was a producer price index report.
Who would have thought?
I know.
Nobody, literally. Okay, the S&P is at the highs of the session, up by about 1.5%. It's sort of a buy stuff, buy bonds, buy stocks. But the weird thing is, if you're buying bonds and buying stocks, why are you buying each? Usually you're going to buy bonds if you're worried about a growth scare. That was the story over the last couple weeks. If you have a growth scare, why are you buying stocks? That dichotomy kind of working its way through the market as volatility remains relatively subdued, Romaine.
Yeah, absolutely. The volatility coming down just a bit on the back of that cooler than expected producer price data. And that's adding to a lot of confidence out there that the Fed may indeed soon cut those interest rates. Now, that PPI report forcing some real money investors to buy Treasury inventory into today's rally and forcing some equity traders off the sidelines to boot. Deutsche Bank's chief economist Matt Lazzetti saying that the market for now is leaning in a very dovish direction.
You still do have inflation that's above target, but I think inflation risks have really dissipated. And so I think the Fed should be very comfortable cutting rates.
Michael Hartnett over at BOFA seemingly echoing that sentiment, saying his internal survey of clients showing investors core optimism for an economic soft landing. Well, that remains unbowed. Still, it should be noted that the stock and bond rallies are a bit incongruous right now, sending different signals about recession probabilities, with hedge fund titan Boaz Weinstein saying bond traders should actually start heeding the signals from the VIX traders and more fully price in economic risk. At least for right now, that ain't happening, though. More than 400 of the S&P 500 stocks poised to close out the day higher, but none poised to gain as much as Starbucks. The biggest one-day gain for the stock after the surprise ousting of Laxman Narasimhan, who had been CEO for just barely 18 months. Chipotle CEO Brian Niccol lured away to help fix things at the coffee chain, a switch that has so far, Alex, been universally hailed by Wall Street as a positive. They're calling him a Hall of Fame CEO.
No brainer, I think, was what Bloomberg Intelligence said. That must feel really good if you're the outgoing CEO. So back to volatility, and this is what Romaine was just talking about. Bear with me here. This is the function CCRV, and it's about the VIX index. And the blue line is the VIX index curve a week ago. The white line is the curve right now. And you can see the tremendous change in volatility. We've really come down on that front end. Now, this sort of blip here is what we're looking at in terms of the elections for the U.S. And naturally, that's going to be trending a little bit higher. It has been for months. But what's significant about a week ago is that current volatility was so much higher than what we were pricing in for the election. But all of that has really calmed down. So, I mean, the question is, have things actually calmed down? Or, like many are now warning about, U.S. credit market and the equity market disconnected from the bond market, and one of those things now has to give.
Yeah, a lot of disconnections out there. I guess it depends on the chart that you look at. A person who studies those charts intently is kicking us off to the close here on this Tuesday afternoon. Amy Wu Silverman is equity derivative strategist over at RBC Capital Markets. And Amy, the last week that we had, was that just a blip? Do we go back now to shorting volatility?
Hey there. Well, look, some people have frankly done that. They've kind of counted on this being a blip. And frankly, some people are doubling down on a lot of those short volatility trades that we've seen. That's created a lot of suppression. But look, I kind of liken this to being on an airplane that's been incredibly turbulent. Yes, we've kind of found the same altitude, but have we forgotten the turbulence? I don't think so. And you see that perhaps not in that VIX headline chart, Romaine, but you do see that in other charts like VVIX or SKEW, which are telling you that people under the surface are still quite nervous, far more than they were prior to Monday.
That's what I'm curious about, too, because we've heard this from a lot of other guests, always pointing to these other sort of metrics on top of the VIX. They're basically saying that when you look at that, you can see that the concern is there. And more importantly, you can see that the risk is there. If those signals are to be believed, or at least taken at face value, how do you position yourself right now, Amy?
Look, something that we've talked about for a long time, frankly, since the beginning of the year, was how incredibly inexpensive the cost of protection was in equity volatility. It had gotten to the point when people were so focused on right tail and FOMO, MOMO, that we were talking kind of 5 and 10-year lows in terms of protecting your portfolio. Has that gone up? Yes. But what we've learned from history is it usually takes some sort of market drawdown for people to think about hedging. They're thinking about hedging now. It has been up that downside, but it doesn't mean that it's not worth it to do something like VIX calls, call spreads, or S&P puts and put spreads, all which are strategies that help you protect that downside risk.
You mentioned looking at, say, VVIX and saying other indicators that show there is a lot of fear under the surface, like the skew. What about cross-asset volatility? Because that really ramped up as the overall VIX went up, and now it's really coming down again. How do you see that playing out?
Yeah, it's interesting. I think one thing investors are talking about right now, and as you mentioned as well, is just this disconnect that we've seen between credit rates and equity volatility. And this isn't the first time that's happened. We've seen this happen before when equity volatility was too low and it had to catch up the other way around. Now I think perhaps this is going in the other direction. But what I'll say is, you know, given the indicators are at cross currents, at some point someone has to be right. It's simply a function of, you know, we're going to either head in one direction or the other come Wednesday and come September, and it'll be clear who's proven. I think in terms of equity volatility now, you have a lot of people who have done really well in their portfolios, are positioning for some sort of downside drawdown, and are concerned enough that they're implementing that protection. So in this case, perhaps we'll see that equity volatility is pointing in the right direction.
Hey, Amy, do you see that formulating around CPI, or is it going to be the Fed meeting, or is it going to be Jackson Hole? Like, where do you see that kind of that those hedge really come forward?
Yeah, it's a great question. I think it's a little bit of everything, Alex. And I think that's why a lot of these zero data expiry options, you know, they've become so wildly popular, because we're in this regime where every single data point has the ability to kind of spin this market on a dime. You've certainly seen that before. And I think we'll see it once again. Look, when you kind of look at, you know, call it the hump in the term structure, obviously U.S. elections, there's one clearly indicated for the VIX. But on the short term basis, CPI and then that Fed statement going into September is incredibly crucial too, because obviously that rate story has been driving everything.
So do we end up with a bit of a reset once we get closer to the election? Or let me rephrase that. Do we get a bit of a reset when we get past the election, we learn the results here? Or is this trade going to kind of filter itself prior to the election and then just continue on into 2025?
Yeah, so when you look to history, you typically get this trade down and this rise in volatility going into the election, obviously a lot of uncertainty. And then you get that kind of release and that rally after it. Now, the only exception to this is for some reason that election is contested in any way, then you can get a sustainably higher volatility level. We've seen that in the past in 2000, for instance, where that VIX level kind of hits 30 or even 35, 40 and doesn't go down for a while. But obviously that's a very unique case, but one we had been talking about for a while, where potentially that could keep volatility elevated even past that November election date.
So as we get there and we get past that, Amy, it begs the question here as to how the market overall performs, not just what's going on in the derivative space here, but when we talk about the broader cross-asset space here and whether they are positioned for these worst-case scenarios or even sort of a middling scenario when it comes to economic conditions or political conditions, are we there yet now?
The short answer is no. And I'll tell you, even prior to last Monday's kind of big spike in the VIX, you can call it, you know, for liquidity reasons, a drawdown from the yen carry trade, you know, what have you. Even prior to that, we were really showing pickup and skews, not only on the market level, but on the Mag 7 level. And, you know, often I've said it really just comes down to the math of the market. We're still talking about a market that's very heavily weighted to very narrow breadth of stocks. And those were all indicating quite bearish going into that earnings season. And we still have NVIDIA left to report, a late reporter, but that bearish sentiment hasn't changed. We haven't seen that change even as VIX has stabilized. And it continues to tell me people are really worried about that positioning and that downside in these heavyweights.
All right, Amy, always great stuff. Amy Wu Silverman, equity derivative strategist at RBC Capital Markets on a Tuesday afternoon, where we see the VIX back below 19 and stocks right now at session highs. A lot coming up here on the show with the producer price index data now in the rearview mirror. Investors looking at the horizon for those CPI numbers tomorrow. Veronica Clark of Citi joining us in just a second to discuss.
All right, plus earnings in that final stretch. Nike shares jumping after rival sneaker maker On Holding reporting its results. We're going to break it all down in today's Stock of the Hour.
And we're also keeping an eye on shares of Cisco. They're scheduled to report earnings tomorrow. And of course, the sentiment right now is a bit dour with orders flat. We're going to dive into what to expect from the ultimate tech company. All that and more coming up in just a second. This is The Close on Bloomberg.
season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
I would think it's prudent for them to cut back interest rates, whether it's 25 or 50, I will leave to the Fed.
That was Dave Rubenstein, co-founder of the Carlyle Group and host of Bloomberg Wealth, on the Fed's rate path following that PPI rising less than expected. Later on today, though, Atlanta Fed President Raphael Bostic saying that he wants a little more data. We want to be absolutely sure. It would be really bad if we started cutting rates and then had to turn around and raise them again. Stuart Paul of Bloomberg Economics joins us now. Stuart, are bonds and stocks and the Fed right now all on the same page?
I think they're getting there. I think that both equity and bond markets are looking for a bit bigger of a cut than maybe the Fed is at this moment in time willing to deliver. So right now, as of today, we're seeing a bit more of a cut in September being priced in, a bit more than a cut and a half is currently priced in. But as we saw just from those comments from Bostic, the Fed is taking a more cautious approach, wants to be entirely sure before it delivers a big cut. So the Fed might be currently inching towards that quarter percentage point cut in September. Markets are getting closer, especially after today's PPI data, to thinking that a half a percentage point cut in September is the base case.
When you saw that data this morning, did that also give you the confidence that we're going to get that cut in September?
I think that at least our base case is that we're going to get a 50 basis point cut in September. A big part of that, though, is that the labor market is cooling more so than even the headline unemployment rate, which is already at 4.3%. It's that the labor market is cooler than those headline figures suggest. When we saw the PPI data this morning, we gained a little bit more confidence that pipeline inflation is starting to wane. My worry is that when we start stacking up some of the components from PPI and tomorrow's CPI print, it'll look like a pretty rough core PCE inflation print later in the month.
But what's the balance with the labor market data right now? I mean, I guess what I'm asking is what's taking precedence for the Fed?
I think that right now the Fed is putting just a little bit more weight on the inflation data. There may be split 55-45 between inflation and the labor market, I think.
Bonds, though, seem to be indicating that something really bad is happening with the economy, whereas equities don't seem to be showing that. Based on the data that we see, is this like a scary disinflation or an appropriate repricing disinflation?
I think that this is an appropriate repricing disinflation. I don't think that it's all that scary. We have had a bit more of a skeptical view of the resilience of the U.S. consumer than most, but we've also been surprised to the upside. Consumer spending has been a bit more resilient than folks have anticipated, including us. But that resilience was supported by a robust labor market. And now that we're starting to see that cooling, that deterioration of the labor market, and risk is skewed towards an upward gap in the unemployment rate, we think that we could start seeing a more material cooling in spending and a more material cooling in growth. The Fed's going to have to deliver relatively swift cuts in the second half of this year if it's going to stave off a more material slowdown.
All right, Stuart, got to leave it there. Stuart Paul, the best of Bloomberg Economics, a closer look at that PPI data that we got this morning, Alex. And of course, we get the CPI numbers tomorrow. And I was just taking a look at the estimates on the Bloomberg terminal. On a year-over-year basis, it looks like that disinflationary trend is there. But on the month-to-month basis, it looks like we are going to get some modest reacceleration in that core number. Yeah, we saw services, right, come down a little bit in the PPI, but then goods ticking up a little bit. Some commodities that are relevant to what we eat, we're moving up a little bit too. So they're, it's not a straight line down for anything, which is interesting because it feels like, is the equity market moving on the disinflation scenario and the bond market moving on the growth scenario? I'm not sure. I don't know, but I should tell you how much I paid for my sandwich today. Oh, how much? Which, let's just say inflation is still here. I'm telling you, my $10 salad place. It's the way forward for you. Where is this secret salad place? It's around the corner. Do I have to drop your name or something and give you the secret knock? You got to tip them. No, I'm kidding. It's around the corner. All right. Well, speaking of $10 salads, we're going to start talking about, I guess, $15 burrito bowls because Chipotle's CEO, well, he's leaving the fast casual chain to spearhead a turnaround at Starbucks. Different companies, but with a lot of the same issues. We're going to get more insight from an analyst that calls the market celebration of Brian Niccol jumping ship premature. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, a look at the big movers on the back of analyst recommendations. And we start off today with Warner Brothers. A downgrade to market perform over at Bernstein as the media and entertainment conglomerate faces challenges in linear TV and struggles to navigate the loss of those NBA TV rights. The analyst says Warner Brothers Discovery is the worst performer among peers, which is a real shame given what I think is the quality of its intellectual properties and film studios. Those shares still bucking the trend today, higher by 6%. Next up, let's take a look at Dell, an upgrade to equal weight over at Barclays. While analyst Tim Long is still cautious about Dell's enterprise server and personal computer business, he sees less downside to the stock now that the negative sentiment around AI has washed out of the share price. Those shares higher by about 5% on the day. And finally, Hormel Foods, the deli meat company getting the lift to buy from neutral over at Citi. Upside potential for EPS this year. That's the view of the analyst, saying that it will be driven by improving trends in retail sales and cheaper feed costs for livestock. Shares of Hormel up about 2%, and those are some of our top calls. Now, we want to stay in the food space and, well, talk about this man right there. He's gone from folding burritos to whipping up frappuccinos. Chipotle CEO Brian Niccol leaving the company to take on a new role over at the coffee chain Starbucks. Shares of Chipotle on the back foot today. Meanwhile, Starbucks having its best gain on record as investors really putting their faith into Niccol's track record. Our next guest, though, says that some of the confidence, it's understandable, but says the transition from Chipotle to Starbucks is a whole different ballgame. Nick Setyan joining us right now, Wedbush Managing Director and Equity Research Analyst covering restaurants. He's got a neutral on both Chipotle and Starbucks. I'm sure you've seen the superlatives out there, Nick, and Brian certainly has a great track record. He went from Taco Bell, did a big turnaround over at Chipotle, now I guess seeking to replicate that success at Starbucks. What's giving you pause about this next transition?
I think his skill set was perfect for Chipotle, right? I mean, it's the same essentially the same category, the same customer, from Taco Bell to Chipotle, and to that younger sort of male Gen Z type of customer. His background was marketing. He was a brand guy. Up until that point, Chipotle had never done any real marketing. No menu innovation whatsoever. So he brought that Taco Bell playbook to Chipotle. And there was a clear problem solved, right? It was to regain the confidence of that sort of loyal Chipotle client that had gone away because of the food crisis or the food poisoning crisis. So, the problem now is less clear, right? I mean, up until 3 quarters ago, Starbucks could do no wrong, positive transactions for year on top of year. And all of a sudden, everything's falling apart. Problem is the consumer is slowing down. And so, it'll be interesting to see what Brian Niccol can do to turn the consumer slowdown around.
I am curious, though, as to exactly what he's walking into here. I mean, there are broader consumer issues affecting Starbucks, but Starbucks has had a lot of issues for years that really have nothing to do with the macro economy. They've had 2 CEOs since Schultz left, or I guess left the second time or whenever. I lost track here. I'm wondering, though, is there a bigger issue here with regards to management, regards to the board, and more importantly, with regards to Howard Schultz's ever presence in this company, and whether that could potentially hamstring Brian as he tries to sort of put his own stamp on this?
Yeah, you know what? I think you hit it on the spot. It's been 4 CEOs in 4 years. Ultimately, I think the biggest problem is you have a overbearing, chairman emeritus in Schultz, and he just refuses to give anyone the appropriate time to kind of brand their own identity on this company. So I think that's probably the biggest problem, ultimately. Now, Chipotle, if you kind of think about where Chipotle was and again, where Starbucks is now, Starbucks is the leader in digital loyalty. Their loyal customer base is not the problem. They're spending more. They're coming in more often. It's the problem is sort of that, one-off Starbucks customer that was an aspirational customer that had a little bit more money during the COVID years. That's retrenching a little bit. So it'll be interesting to see how Brian kind of goes after that customer because, most of their things are pretty much in order.
So, Nick, is that a return to your core customer, core product, or is that expand product to bring in those aspirational buyers?
Well, that's just it, right? The core buyer is still there with Starbucks. The interesting question is how do they expand and address that sort of non-core Starbucks customer who happens to be a little bit of a lower income customer, a little bit of a younger customer. And remember, this is all in the context of, pre-COVID versus post-COVID. Breakfast just isn't as big of a day part as it used to be, not just for Starbucks, across the entire industry, including McDonald's, right? So that habitual urban customer going in at every morning and buying a cup of coffee is no longer as big of a customer. Plus, you're a lot more of a suburban concept now. The Midwest, the Southeast is a much bigger part of the Starbucks system than it used to be. So there's a whole host of issues that need to be addressed.
Before we let you go, do we learn anything about how Brian handled things at Chipotle and Taco Bell in terms of how Starbucks might manage China?
Unfortunately, both Taco Bell and Chipotle are very much domestic concepts. So he doesn't have a lot of experience on the global scale.
So we don't know yet. All right, Nick, we really appreciate it. Thank you so much, Nick Setyan, over at Wedbush, joining us. I got a $7 coffee order and a $10 salad. Just putting that out there. All right, staying with Starbucks.
Yeah.
Let's weigh in on this debate. Fall's coming early this year, guys, because pumpkin spice, the lineup is coming up here in the U.S. at the end of August, and also in the U.K. They just announced a couple days ago that autumn and winter favorite pumpkin spice latte is back in select stores in the U.K.
Wait, so Starbucks gets to determine when fall is? I thought that was up to like the astronomers or scientists or whoever. Like,
I thought it was up to Walmart.
Look, if you like pumpkin spice, why not just make it a year-round thing?
I'm with you.
I mean, it's not my cup of tea, cup of coffee, pun intended, but I guess if people want to enjoy a hot pumpkin spice in 100-degree August weather, they should be allowed to.
Although, in defense of the UK decision, it will be like 56 degrees on a low in the next week. So, it's 56 to 60. I could do a pumpkin spice latte in 60 degrees.
Celsius?
I have no idea.
Okay.
Let's call it 25.
Okay.
And see if I'm right.
That could be right. It could be wrong. I have no idea.
It could go either way.
Yeah, I mean, I remember Caroline Hyde, who was our chief UK correspondent. She, at some point, explained to me the whole conversion thing. And it made sense. And then, of course, I forgot it all like 3 days later.
Well, yeah, because we're the only people that do Fahrenheit. So we should just get with the program and do Celsius.
I know, USA or something to that effect,
yeah.
Right? Yeah.
All right. Well, anyway, taking a look at the markets here, we are still right around the highs of the session for the S&P, up by about, looking at it, 1.5%, a huge move. You're looking at a big move also within technology stocks. Coming up, we'll talk to Jennifer Barker, Global Head of Treasury Services and Depository Receipts over at BNY. It's really a liquidity conversation. We'll break that down with you. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele, right around the highs of the session. Here's my question. Are we now one-sided again?
It's all, I don't know. I mean, if you ask me that question tomorrow, I probably have a different answer than the one I give you today, because that's basically been what the market is. It seems like you still have this tug of war, this sort of push-pull of where people think the market is going, which of course is largely based on where people think the Fed is going to go.
Right, but that feels somewhat consensus. The Bank of America Fund Manager survey said, 93% predict lower short rates, 76% soft landing.
Yeah.
That's like everybody.
Okay, well, that seems literally lopsided.
That's what I'm saying, a lopsided point. All right, let's turn now to liquidity. A year ago, the Fed launched Fed Now service to let banks send and receive payments 24/7, 365 days a year. So think of it like an instant payment system for people and businesses. And one of the first banks that signed up to do so was BNY, one of the top 5 players in the dollar payment market. Joining us now is Jennifer Barker, Global Head of Treasury Services and Depository Receipts at BNY. Hi, welcome. Thanks for joining us.
Thank you so much for having me. It's great to be here.
So it's been a year, right? Fed Now service. We probably don't know what that is. Tell us about it. How's it going?
Absolutely. Before I do that, let me just do a bit of level setting on BNY. So it's been quite the year. We celebrated 240 years. We're the oldest bank in the U.S. and we think about what we do in managing money, moving money, and keep it safe. So for what I do in Treasury Services, we move money. And so we send payments, we invest in concentrate cash, and we finance trade all around the world. And just to give you some context, we're a top 5 global U.S. dollar clearer, and we clear about 3 trillion payments a day.
Wow, a day.
A day.
So what are you noticing? How is that?
Right. Well, yes. So it's very interesting. There's a lot of really interesting market trends, but let me answer your question on Fed Now.
Okay.
So there are 2 instant payment rails in the United States. The first is FedNow, which was launched last year by the Federal Reserve. And the second is real-time payments, which was launched in 2017. And there are about 900 banks and credit unions today live on collectively on both of the payment rails, and there are about 70% of accounts in this country are able to receive an instant payment. So what we're seeing in terms of usage is a couple of different use cases. First is payroll. So think about, regular payroll and then what we call gig economy. So people who work multiple jobs. And so to be able to be paid every day or even after every shift is a real differentiator for employers, particularly in a tight labor market. Second is urgent payments. So think an insurance payout, an emergency loan. And so we think that there's more to do, though, because there's 900 banks. And so technology adoption continues to be something that our clients tell us that they need some help with.
We'll talk a little bit more about that client adoption, because we've heard from a lot of companies basically saying that the cost to transition to this, at least for right now, is just a little bit too onerous. And we're kind of talking more mid-sized companies. Sure. Obviously, the big conglomerates have the cash to do it. But what do you do? How do you sort of consult with those sort of mid-sized companies that want to do this but just don't see the financial benefit?
So one of the things that we do is we actually have technology that is what we call a smart router. So it doesn't matter if it's FedNow, it doesn't matter if it's real-time payments. We actually connect once, and we actually help them through a single technology connection, route it to the right place. So that really takes a lot of the technology burden off of our clients.
Are they asking, though, when we talk about tapping into FedNow or maybe some of the other systems out there, there's been a lot of discussion as to whether particularly small and mid-sized businesses, whether they can rely on just some of the more fintech type of companies, if you will, like PayPal, Venmo type of thing, to do their transactions in quote unquote real time. I know you don't get the same settlement and clearing as fast with something like FedNow, but for a lot of companies, they'll say that's good enough for us.
Well, I think that there are many other payment rails in the U.S. and around the world, right? So the benefit of connecting with banks is that you get access to all of those things. And again, back to the technology burden point, you don't want that burden. You don't want to put that burden back on your clients. You want to put that burden back on your bank and your technology institution.
How do digital currencies factor into your job in BNY?
So digital currencies, we focus more, we don't focus as much on digital currencies. We focus more on fiat and really making sure that we have instant payment rails up and running and really getting the economy and instant payments adopted. I mean, there's still a lot more work to do there. There are still 8,000 plus institutions in this country, banks and credit unions, that have not adopted any sort of instant payment rail.
So what's your pitch to them? So you're like, hey, come to the 21st century. This is what we're doing. Like, what's the pitch?
The pitch is instant payments solve a lot of issues, right? And so we talked about payroll, we talked about, emergency funding, but, you have a lot of economists on this show and, they talk about pressure points in the market, and small businesses, sometimes fail. It's not because they have a poor product and inferior service, it's because they have liquidity challenges. And instant payments really help solve that.
There's been but we've also seen a lot of other big banks either enter this business or expand. I'm talking about treasury services businesses overall. So there's a lot more competition for a business that I think, I don't know, if you asked people 20 years ago, they would have been like, why will we commit a lot of time and effort to this? A lot of people are chasing after this now. Why? Is it because everything is just more digital in terms of the way we move money around?
Well, in terms of instant payments?
Yeah.
Yeah, I mean, it allows you to have complete control over your working capital, right? I mean, when I talk to clients, that's the number one thing they talk to us about is they want to have complete control over when they make a payment. I mean, hours and days matter in terms of being able to really control your working capital.
Another big part of your job, though, is also making sure, guarding against fraud and making sure basically that payments are legit.
Yes.
Right? Has that gotten harder?
It's gotten more challenging, particularly as more global that you get. But you have a lot of tools to help you, right? Whether it's artificial intelligence, whether it's account validation tools. But yeah, I mean, it's something that we invest in very heavily, given the large role we play in the financial ecosystem.
Under your umbrella, basically the business you manage, have you used a lot of sort of artificial intelligence and other language models in your role?
We have, and we use it really primarily two ways. We use it to really enable our client-facing teams to spend more time with clients, so to be more efficient. We also use it to really help our clients get more insight into their own data.
All right, Jennifer, this was a great conversation and great to have you here on set. Jennifer Barker, she's the Global Head of Treasury Services and Depository Receipts over at BNY. And this is like one of those topics, Alex, it gets really in the weeds, right? I mean, obviously she's way smarter than us, but when you really look at it, you realize just how critical it is to liquidity of companies and to a certain extent, the liquidity of markets overall.
Absolutely.
Yeah.
Hands down.
Yeah.
I mean, if someone was like, here's your check, but you can't have it, your money for like a week, you'd be like, no, I need it now.
Yeah, I don't know.
Direct deposit? Like, I remember a world before direct deposit.
I know, we're all old enough to remember the days where it was like you write a check and you had to wait a long time for it to clear. All right, keeping an eye here on the market. Stocks still holding on to the highs of the day. We're going to take a closer look at some of the individual movers that, are moving in slightly different directions. Home Depot, the share is higher on the day, but the company did flash a warning about the U.S. consumer. We're going to talk a little bit more about what's ailing the consumer. That's coming up in our Stock of the Hour next on The Close on Bloomberg. Welcome back to The Close. Time now for our Stock of the Hour and a focus on the consumer. We're going to start off here with Home Depot. The share is moving higher despite an earnings report out of the home improvement retailer saying that consumers right now are in a, quote, deferral mindset. Jess Menton joining us right now, helps to lead our asset coverage here at Bloomberg. This was kind of an interesting commentary. I guess it shouldn't be surprising because we heard from so many other companies that consumers are pulling back on a lot of things. So you would think a big ticket type of purchase like a home remodel or something would certainly go on the back burner.
Right, and a lot of people pushing it back because, not surprisingly, when you have interest rates at the highest in about 2 decades here, and we've seen that happen over the past few quarters where their same-store sales growth has been sluggish. But it's interesting because you're seeing that stock up, if you look at HD is the ticker symbol on this, about up more than 1%, but its stock really has gone kind of nowhere this year. For the year-to-date basis, it's still up around 1% as well, and it's also underperforming its rival Lowe's. Actually, Lowe's will report earnings on August 20th, but it's a little bit of a different story when you're thinking about the DIY-type projects that go on with Lowe's versus some of the struggles that Home Depot tends to have.
What I find so interesting, though, is it's deferred projects. So what? It's like 30-year mortgage rates go down, like 100 basis points, and all of a sudden everyone goes to Home Depot. Like, is that true, or is that sort of like wishful thinking at the end of the day, right?
I know you were mentioning you were putting off a couple different things to work on as well, but it's interesting, right? Yeah. But when you're thinking about a particular segment of this, and especially how it's tied to housing and what that means for the economy, it's interesting at a trajectory and an inflection point like this when you do have the Federal Reserve and especially CPI tomorrow, where people are hoping that next month will be the first time they cut rates since the depths of the pandemic.
And of course, I'm sure, as you know, Jess, the whole market right now, whether in equities, bonds, or whatever, is really focused in on economic conditions and whether we keep spending. I know we're going to get Walmart earnings in a few hours, and that'll give us some insights. But we also got some earnings this morning out of a big shoe brand, and that's On Holdings, which didn't even exist a few years ago.
That's right.
But those shares rallying 5% here, 28% jump in sales. What's going on?
And also, a lot of it had to do with, there were these sky-high type of expectations, but when it comes to maybe some of these more kind of luxury type of shoes, they actually saw some stronger demand there that I think surprised some people. And if you look at the A&R function, though, for this particular type of company, it actually has 18 buys, 3 holds, and actually 2 sells right now. So this stock actually outperforming and actually doing a little bit, holding up better than people were expecting, despite going in there with those high expectations.
Yeah, and Nike also jumping now.
That's right.
About 5%, because you can kind of, is that a drawing parallel thing? People buy sneakers, thus they like Nike?
And they're all also in a little bit of a different type of category there, but when you do see some of its peers on the back of this, it's kind of rising tide sort of lifts all boats in this particular segment of the market today.
Yeah, and maybe it's just the idea that we are buying something that for a lot of us is going to be discretionary, right? I mean, we don't necessarily need new sneakers.
And that's a good point, because you want to see people with the discretionary spending, so much talk about the economy, where people are putting it. And if you're looking at the equal weight discretionary versus equal weight staples, you're still seeing that outperform when you're taking out the noise from, say, the Amazons of the world and things like that. So that tells you overall with the economy and the Atlanta Fed GDP Now model around 3%, still things holding up pretty well here.
All right, Jess.
Do you remember Lottos?
Lotto?
The shoes? No.
Anyway,
all right.
What were Lottos?
They were these shoes, but what you could do is the logo was Velcro, so you could change the colors to match.
Oh, I like that. I remember the LA gear and they would light up. I love those.
It was a really cool thing, and I don't know. I was. Okay, I'm just reminiscing about my childhood here. I don't know if those things still exist or when they went out.
It's been no surprise, but I was never allowed to wear those cool things when I was a kid.
Wow.
Oh, no.
What?
I mean, I know it shouldn't surprise anyone.
I definitely had to light up LA gears.
Wait, you just wore potato sacks to school, cardboard boxes on your feet?
No, my mom would be like, let's shop discount designer at like Sims. And then I'd be like, but I'm 7. Anyway, Jess, thanks a lot. Love you, Mom. Bloomberg's Jess Menton joining us there. So let's stay with luxury for a second, because the Home Depot's TBD, but clearly not when it comes to Uber luxury. According to the CEO that was on surveillance for 4 seasons, talking about, in general, demand is super strong. And it's not just about how pretty the hotel is, but it's also about the experience and all that kind of stuff he was selling.
Yeah, and it gets to this idea of kind of the dual track economy where you have people of means that are still doing well and, more importantly, willing to spend. But I think you used the right word there, and it's experience, right? Like, you have to kind of offer something more than just the product itself to make people feel like the cost is justified. So if you do give them these sort of grand experiences like you get at some of these four-season resorts, I could see why maybe he's optimistic.
Yeah, and he's talking about how the engagement's really good. So they invest a lot of the employees so they can be super engaged with the fancy people and the fancy hotels, etc.
Oh, yeah. I don't want them engaged with me. I just want them to kind of leave me alone.
No. But then you call and they're like, yes, Mr. Bostic, what can I do for you? Would you like me to send that masseuse and have that, really expensive dinner reservation for you in your Bentley?
That sounds kind of nice.
See?
Yeah.
He's buying it. All right, coming up, we're going to take you to the closing bells. Rebecca Patterson, a former chief investment strategist at Bridgewater, will be joining us. This is Bloomberg.
Frankly, some people are doubling down on a lot of those short volatility trades that we've seen. That's created a lot of suppression. But look, I kind of liken this to being on an airplane that's been incredibly turbulent. Yes, we've kind of found the same altitude, but have we forgotten the turbulence? I don't think so.
Amy Wu Silverman there over at RBC, and I love that analogy that she used, Alex, because I'm the guy on the plane that keeps the seatbelt tight the whole ride, and the second I get a little tremor, I'm like cinching it tighter here. But I just wonder, has the market just given up? I mean, they just decided that, the last 2 weeks didn't matter, and we're off to the races again?
Well, Goldman was saying today that equity and bond markets assigning a 41% probability of a U.S. recession. So why are we buying stocks?
41%? Is that high?
I don't know. It's up from 29% in April.
Okay.
That's something.
All right.
But it does raise the question of, are all the markets telling us the same thing?
Yeah, I don't think they are. I know we had Stuart Paul on earlier. He kind of says that, he thinks they are telling the same thing. But it'll be interesting to see. They might be telling us the same destination, but I think the journey to get there, what they're telling us there, is a little bit different here. You're still looking at stocks here on the day, right around session highs, 54.25, on the S&P.
Yeah, just take an energy, and we're like all higher within the S&P there. So energy, the big dragger.
Absolutely. Rebecca Patterson joining us right now. She's the former chief investment strategist over at Bridgewater Associates, helping us count you down to the closing bells just about 8.5 minutes ago. And Rebecca, I guess that is the question here, is kind of like, it seems like a lot of people agree on the destination, right? The idea we're going to get rate cuts, the idea that we are going to get some economic softness, but there seems to be a lot of difference in opinion about the degree of that economic softness, the degree of Fed rate cuts, and more importantly, the degree of how the market's going to react to it.
Exactly. Yeah. No, I think you summed it up really well, and I also like your turbulence comment. I am you. We're going to have more turbulence. I'm sorry for us. We're going to have our seatbelts on because the market isn't decided on the journey or the bumpiness of this landing. And so every piece of data is going to be soft landing, hard landing debate, and the stock market and the bond market are going to react to those. I don't think we're out of the woods yet on that. Today we had the NFIB, the Small Business Sentiment Survey. It was better than expected. And important to me, hiring plans were steady. So they're not, the small businesses, which is the bulk of companies in America, are not looking to lay off workers yet. So that's really good news. That's soft landing news. The PPI today suggests the Fed might be able to start easing quickly. That's soft landing news. But then you have other companies announcing layoffs and consumer confidence data that's not great. And so, we don't know. I think anyone who says they know which kind of landing we have right now is not being very authentic.
And this is a good time for a shameless plug that we'll be interviewing Holly Wade, the executive director over at the NFIB, a little bit later in the program. I am curious, though, about Fed rate cuts.
Yeah.
The market is convinced we're going to get something in September. Bloomberg Economics thinks we're going to get 50 basis points and maybe even another 50 before the year is out. Is that going to change things? And I mean, not for the market so much, but for the economy, and more importantly, just for regular people who are out there spending on their credit cards or trying to buy a home or a car or other things on credit. Is that going to matter?
Yeah, I think there's a risk that just like rate hikes were slow to feed through the economy versus what had been expected, rate cuts might be similar. And the main reason I'm saying that is the housing channel, which is the biggest transmission channel for monetary policy. So right now, a 30-year fixed mortgage is about 7%. So off the highs, but still pretty darn high. If you go back the last 15 years or so, the average was under 4%. Now, if I'm one of the many people who locked in something closer to 3.5%, 4%, if I don't have to move, even if the Fed cuts 100 basis points by year end, I'm still getting a lot less house for my money. Housing costs broadly are up. The mortgage is expensive. So I think it's going to take longer for people to feel unlocked till they have that wealth coming through housing.
This is my moment, 2.75%. And I feel okay about that, saying that out loud all the time.
She says this every day. She literally just walks by my desk and whispers in my ear, 2.7.
I mean, it's
and then just
like,
keeps walking.
I don't know. I was really proud of myself. Okay, but to that point, that's on the consumer side. But on the company side, in terms of investing CapEx, you have that uncertainty. You have the cost of capital maybe not coming down as fast as one might think. And then you have election uncertainty. So the CapEx cycle that we keep expecting, does that happen?
I think a lot is on hold till after the election because the differences in policy between the Republicans and Democrats, especially on things like taxes, are pretty extreme. So if I'm a CEO and I'm making a 5-year or a 10-year strategic investment, I want to wait as long as I can to get the bang for the buck from lower interest rates if they come. And I want to have more clarity on what kind of tax reality I'm going to be facing. I don't think we're going to know that even on, mid-November or early December. I think that's going to be later 2025 before everything starts to get flushed out.
So what's the best allocation within equities and broadly with that scenario?
I mean, given that I think we're kind of on the fence between soft and bumpier landing, I prefer to be somewhat defensive in my allocation right now. I still like large caps. I like U.S. large caps. That's going to include tech still. I like it as a structural longer-term investment. I like having some defensive positions. I know energy's getting hit today. I like energy as a geopolitical hedge and with super attractive valuations. But then outside the U.S., I think the U.K. is interesting, especially domestic stocks. Extremely low valuations. No one owns it. The Bank of England's going to start a rate cutting cycle later this year. But importantly, it is what we call a low beta market. It tends to move less on the downside. It acts more defensively if stocks go down. So if you want some geographical diversification with the U.S. election coming up, I think that might be an interesting place to hide a little bit.
That's an interesting call there. I'm going to look deeper into that. What about Asia? You find anything attractive over there?
I mean, the news out of China right now is making my hair poofier than normal. This is an economy that's struggling so hard to get growth, and yet they're intervening because they don't want their bond yields lower. They need low bond yields. And because they won't let their bond yields lower, consumers are saying, I don't know where to put my money. I can't put it in bonds and stocks. So they're all going into gold. So gold is another thing I like in this environment. But until China really stabilizes and the consumer there gets going, I'm staying a little bit anxious about Asia, generally speaking, and also Europe, because Europe is much more dependent on China than the U.S. is.
I'm going to squeeze in just one last quick question on gold, because the run-up that we've had here, do you think that has been driven more by concerns about what's going on outside the U.S.?
Yes. I think that most of the run-up we've had over the last year and a half is China. China's central bank diversifying and China consumers desperately looking for somewhere to save and grow their money.
All right, Rebecca, going to have to leave it there. Always a wonderful conversation. One of the best out there, Rebecca Patterson. She's the former chief investment strategist over at Bridgewater Associates. With just 3 minutes until we get to these closing bells, stock's pretty much right around. Actually now hitting fresh session highs, Alex Steele, as we get closer to the bells.
Yeah, look at that volume, though. It's still really light, so I wonder if volume's going to kick in tomorrow around 8:30. Well, I guess 9:30 when the cash opens, and if that's going to make a difference in direction.
Yeah, you're referring to the CPI report tomorrow, and then we get the retail sales the day after that. The market's going to have a lot of macro data to parse.
Yep, especially when we talk about being so one-sided, right? That fund manager survey, Bank of America, 76% expect a soft landing. Again, that feels very one-sided.
Yeah, and it's been like that for a while. And it gets to the question, too, is like when you heard Amy saying that, not everyone's short vol, but people aren't necessarily going long vol at the moment here. Anyway, we have our full coverage breakdown of all the events of the day, starting right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Seal, taking you through the closing bell. It's a global simulcast, starting now with Scarlett Fu here in the TV studio, Carol Massar and Tim Stenovic in the radio booth, as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube, Carol Massar.
Yeah.
And you're smiling.
Why
Is that
not?
because you're looking at the green on the
YouTube
screen?
fan.
It's sunny outside. It's not raining. The humidity has come down. And the VIX, look, we lost about 2.5 points. We're down below 20 again. So everything is awesome.
Yeah, I mean, the PPI came in.
Famous last words there.
Bed-friendly.
Exactly.
Everything is awesome. Plop.
Ish.
Ish. It was a Fed-friendly report. All eyes now to CPI tomorrow. We'll see what happens. But look at all the green on the screen. Investors optimistic.
The soft landing narrative is back. It's like, the global market meltdown didn't actually happen.
Guys, but then we're still seeing a huge bid into the bond market. That feels to me, is that still a fear factor? Or is that just, hey, Feds are going to cut. It's all great. It's still the soft landing. I'm skeptical, guys. I'm skeptical.
That's a great point, right? We saw both bond and stocks moving higher today, right? I thought they weren't supposed to do that.
Buy all the stuff.
Yeah, and that's the other question, too. It kind of raises this whole conundrum for the Fed. You start to look at the differential between where Treasury yields are and where the Fed's funds rate is. And then if you want to overlay the differential with where headline inflation is, or even core inflation is, I don't know, is the Fed behind the curve?
I don't know. We just spoke to Aaron Kennan over at Clear Harbor. He's cautiously optimistic that, a soft landing could be on the horizon. Maybe 3 rate cuts by the end of the year, 75 bips.
Yeah. Well, a bit of risk appetite coming back into this market. You see that with the VIX tamped down, Bitcoin back above 60,000, and green for most of the major indices here in the United States of America. The Dow Jones Industrial Average up by about 400 points or 1% on the day. The S&P looks like it's going to close higher by 90 points or about 1.7%. The NASDAQ adding about 2.4% on the day, while the Russell 2000, Carol, higher by 33 points or 1.6%.
Yeah, and I thought it was interesting, too, to see some kind of buying into the close here. The S&P 500, Scarlett, you're going to go through the industry groups, but you have 425 names in the S&P 500 gaining ground on this Tuesday, and Scarlett, only 75 to the downside.
Yeah, it's pretty lopsided when you look at the sector performances as well. Here's the IMAP, pretty much your pesto pizza. There's some red slices there. Energy down 1%. And food and staples also, kind of mixed right now, but really it's energy. Everything else is green, particularly tech, up 3% on the day. Consumer discretionary up 2.4%. And communication services gaining 1.5%.
That is a brat chart. I'm just going to say it.
Wow.
I know.
Very 2024.
Thank you. All right, let's get to some of the individual gainers. Starbucks finishing at its highs pretty much of the session, up 24.5%, soaring the most ever. It is your number one gainer in both the NASDAQ 100 and the S&P 500. We know the story. Chipotle CEO Brian Niccol, he will be taking over the top spot in September. Big deal. We know the activist investor Starboard has been looking for some kind of shakeup, but nonetheless, all eyes and ears going to be watching on this one and what it does to kind of change around some of the metrics that haven't been so good. I mean, this company, 2 straight quarters of comparable sales declines. We've seen the stock under pressure. So not today. Very different narrative around Starbucks. All right, Supermicro, also an outperformer in today's session, finishing the day with a gain of about 5% here, top in the S&P 500 and the NASDAQ. I got to be honest, not sure why some investors may be looking forward to some upcoming investor conferences in August and September in which the company is participating. Maybe there's some news that comes out of it. Our BI team, though, was
remember,
out with
Carol,
a note.
they had pulled out. Remember, there was a lot of concern that they had pulled, and now they're basically saying they're going back in. So, I don't know, let the speculation
This is why
begin.
we have you, to keep me honest.
Is this why you have us? I thought it was just to get you coffee and tea.
That, too. Our BI team also out with a research note on Supermicro, saying that the company is poised for sustained AI sales and EPS lift through 2025. And one more on holding, up about 4.3%, well off its highs of the day. At its highs, up more than 9%.
Is this a semiconductor company or the shoe company?
No, on holding, the shoe, the ticker on.
Roger Federer wears them. It's his sneaker company.
Carol Massar wears them, too, so don't make fun of me.
You would never. They're apparently really cool.
There you go.
Thank you. I was a little worried. It also brought names like Nike, Foot Locker, Dick's Sporting Goods, and Under Armour also moving to the upside as a result. On holding, they were down initially in the pre-market, but finishing the day, as we said, up. Second quarter sales topped estimates. They did have a small profit miss, but nonetheless, the company also did back its full-year guidance of at least 30% sales growth. So there you go.
All right. You got the gainers. I got a couple decliners, and
it was hard, right?
Yeah, it was actually so hard that one of my decliners turned into a gainer, guys.
Just barely.
Wow.
Just barely. I'm busted.
Okay, you
That's
want to start from the bottom and go up? Or
No, I want to start with Chipotle. Start with something firmly in the red today. Shares fell as much as 14%. At one point, it was the most intraday since March of 2017. This after the company said chair and CEO Brian Niccol is going to leave the company at the end of the month. He's going to become chair and CEO of Starbucks. We just heard that from Carol. Starbucks, for its part, or Chipotle for its part, rather, COO Scott Boatwright was named Chipotle's interim CEO. Analysts acknowledge Niccol's departure adds uncertainty, though they are confident in the outlook for the company given its leadership team. Also, keep an eye on shares of Baxter International. Ended up falling 6.55% today. The company said it's selling its kidney care segment to global investment firm Carlyle for $3.8 billion. Investors, though, Alex, it seemed, wanted more. Shares falling by 6.5%.
All right, taking a look at the bond market, there was some moves here, buying all across the curve, particularly in the front end. I think I said exactly those same words yesterday as well. We're at the lowest level for yields since the beginning of August. So quite interesting there, guys. We're down for about 2 straight days. I feel like this sets us up. I wonder how clean positions will be as we head into CPI.
Yeah, it's a really good point, right? We'll see whether or not how tested they might be. All right, guys, let's get to some stories that have definitely caught our attention. Once again, some data out showing gender differences, and once again showing women being more flexible than men. Just going to put that out there.
That's why you picked the story.
You got it. All right. There's a gender divide in how recent college grads are responding to a cooling U.S. jobs market. It turns out college-educated women are sticking with their jobs and their job search, even as the number of vacancies shrinks. Many of their male peers are choosing, Tim, to take a break and maybe back off of it.
Yeah, so 1 in 5 under the age of 25 are neither employed nor actively looking for work. This according to the latest 12-month average in a Bloomberg News analysis of government data. It contrasts, Scarlett, with the data for female grads. It shows their participation rate is holding broadly steady over the past few years.
And the reason, as Carol alluded to, women are more flexible in that they're more likely than men to take on part-time work, or maybe something that they're overqualified for, or maybe not their first choice, but they're thinking, you know what, I'm going to work, I'm going to support myself, and then I'll trade up as I, continue along.
I don't get it. So then what do the men do? So if they're going to take a break, like, what are they doing?
They're living with mom and dad.
Like, how do they eat and buy stuff?
Mom and dad.
Well, but it does also sort of illustrate something bigger about the economy, and that job market is cooling. So not just for recent college grads, but look at the July payrolls report. I mean, this is exactly what the Fed wanted to have happen, to cool the labor market, to cool the economy, bring inflation down. But there are some implications for those college graduates entering the workforce.
Did you see where it also said, oh, wait, women are better than men? I don't know if you saw that, paragraph 5. All right, all yours.
Wow, I don't know. I don't know how I feel about that. But I guess we're outnumbered here, Tim, 3-2 here. Speaking of which, Carol, the next proposal that you get from a significant other, it might not be with the real diamond ring.
I'm done.
I don't know. Who knows? But you never know, Carol. And apparently, a lot of the companies out there, including Pandora, the CEO, is actually a little bit concerned here about the rise of lab-grown diamonds. They've really caught on now. Remember, when this first started, everyone kind of just thought it was kind of a gimmick. The uptake was really low, like 1 or 2% of sales. Now we're up to like 20% of sales. And the CEO of Pandora says that could grow to like 80% of sales within the next decade or so.
Yeah, and it's a pretty incredible, this move within 10 years. I know my brother proposed to his fiancée, and she specifically requested a lab-grown diamond, and he had to go all over the diamond district to look for one.
Actually, funny you say that. I also know people who've done that too. They're like, don't spend the money on a real diamond. That's ridiculous. Get something shiny and pretty, and then we'll just do it that way. But I'm with Romaine on this. I feel like this has been a slow burn. I remember doing segments about this like 15 years ago, and it was like, no one's actually going to buy this. And now, boom, finally.
So what has changed? Have consumer interests changed?
Money?
Or is it because prices?
Based on what I've seen, they're significantly cheaper. And if you can't tell the difference, like I couldn't as a layman, you can't tell the difference. Why wouldn't you do it?
I think it's a great thing. I think there's a lot of controversy and things around diamonds and what you have to do to kind of find them. So that's fine with me. So the next time I get a proposal or get married, it'll
kind of wish this would have been a thing just a few years ago when I was going through this whole process.
Oh yeah, where'd your
anniversary rings. Tim.
Yeah.
Anniversary rings.
Okay, thank you.
All right.
Good call.
On that note, we're going to say goodbye. All right, that's a wrap for our cross-platform coverage. Radio, TV, YouTube, Bloomberg Originals. We call it, what do we call it? Oh, yeah, the closing bell.
What do we call it?
It's just that kind of a day.
Wow.
All right.
Thinking about her diamond.
It's Tuesday.
All right.
Yeah.
Yeah, it's
Goodbye,
Tuesday.
girl.
All right, goodbye, everybody.
All right, coming up here on the big program, we continue our focus in on the consumer, a focus on the economy. Veronica Clark over at Citi. She's going to be joining the big program in just a few minutes. This is Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. A bit of a rebound rally today, to put it mildly here. A lot of people were wondering whether the rally had completely dissipated here. And we got that PPI report this morning, and I guess that was enough for investors to have renewed confidence that the Fed will indeed start cutting rates soon. A 1.7% gain on the S&P 500 on the day. But take a look at the Mag 7, a 3% gain there, 2% on the NASDAQ indices here. As a lot of people now, I don't know where this renewed confidence is coming from, Scarlett, because when you take a look at the consumer, or at least some of the companies that are in the consumer space, they're not necessarily feeling the love like we saw today when it comes to the numbers on the screen.
Well, if you're feeling dovish, then it's just all the more reason for the Fed to start cutting rates, and soon at that. All right, let's take a look at a couple big movers here. Normally, the Mag 7 dominates the leaderboard for the most actively traded stocks by value. But today, you actually have two restaurant companies in the top 10. We're going to start with Starbucks, rising by the most ever, up 25%. This, of course, after ousting its CEO following two straight quarters of declining comparable sales. It announced that Chipotle's CEO, Brian Niccol, will join starting next month. And Chipotle, as you can see, taken by surprise here by Niccol's departure, off by 7.5% on the unexpected exit. Its COO will take on the interim CEO job for the moment. Alphabet shares gaining 1.2%. Worth noting here because Google debuted a new line of Pixel smartphones, earbuds, and smartwatches with AI capability that the company hopes will put an end to the recent slump in its share price, a slump that's removed hundreds of billions of dollars off its market cap as investors were worried that all that spending on AI was not paying off just yet. But our top story this hour is small businesses are feeling better. The latest read from the NFIB shows optimism climbing to the highest in more than 2 years. A key part of that improvement is better news on inflation. The share of firms planning price hikes declined to less than 1 in 4, while data on wholesale prices showed a smaller than expected increase in July, which lays the groundwork for the Fed to start cutting interest rates as early as September. Romaine?
All right, and we do want to go back to that Starbucks story. You saw what the shares did today here, a vote of confidence for Chipotle's Brian Niccol, jumping ship from the burrito chain over to the coffee maker. And it's now raising a lot of questions here, well, about CEO transitions, or really executive transitions overall. Beth Kowitt is a Bloomberg opinion columnist and has been writing about this for quite some time. And this was a pretty interesting one that we got this morning, not so much because of Brian Niccol's leaving, but also the fact that Laxman Narasimhan really only had about, a year and a half to try to execute his vision. And I guess that wasn't good enough for the activist investors and for Howard Schultz, so he's out.
That's right. I mean, a year's not a long time to turn around a company, especially one where Howard Schultz, previously in the picture, really set the strategy before he walked out the door. So I do think it was, he wasn't doing a good job, but it's been fast. I am curious, though. You wrote a great column, I think it was a couple weeks ago. This is when Joe Biden exited the political race. And it was all about executives, corporate CEOs, kind of overstaying their welcome. I'm going to pose this question. It's a loaded question. Howard Schultz, he's had two CEOs since he officially first stepped down. Neither one of them stayed around for long. He's always been sort of that constant, though, in the room, looking over their shoulders. Is he the problem? I think you could argue he is. He is part of the problem. I mean, I think it's hard to recruit really strong candidates when you have this figure who is looming in the background, and that the board's reaction seems to be, when things get tough, let's bring Howard back. Yeah, and he's an outsized figure. I mean, he's not the founder of the company, but he might as well pretty much be, given his nature.
It's a familiar tune because we've seen that play out at Disney as well, where Bob Iger has actually left and come back and has actually extended his tenure yet again. You point out in your column that organizations and leaders need to leave need to know when the time to leave is, and maybe that's when they're at their peak. Could you make the argument then that Brian Niccol is leaving Chipotle at the right time?
I mean, I definitely, and look at what it's done for him. He's landed at a really strong brand. He kind of did what needed to be done, and it allowed him to step into a new role that is really exciting. I mean, if he had left on the decline, obviously different kind of opportunities would be in front of him.
Beth, I'm curious. We were just talking about this story in the Bloomberg about how it's harder to get jobs now for new college graduates, and women are doing better because they're more likely to take part-time work or perhaps something that's not exactly a perfect fit, but they're willing to be flexible. Does this same dynamic, do you think, apply to female CEOs and female leaders outstaying their welcome?
That's interesting. I mean, I think I would argue that we have not had enough case studies of that since we have so few female CEOs. So I think time will tell on that one, but tough call.
Yeah, I mean, Nancy Pelosi certainly was at the height of her power. She left, and she did make way for Hakeem Jeffries. So, she stepped down when her power was at its peak. But she did. Yeah. She did.
Yeah, no, I think that's a really good question. But I do think maybe we can have more women in the top job before we kind of see how that plays out.
Fair enough.
All right. Great stuff. Beth Kowitt, Bloomberg Opinion columnist here. A closer look at some of the CEO transitions that we got today and really over the past few weeks, months, and years. As we continue on this topic and the reshuffling that we see in the C-suite, there's new data out on this that is pointing to tougher conditions ahead. CFO turnover is rising above levels seen the past 2 years. This is according to research conducted by the recruitment firm Calder. Bloomberg's Nina Trentmann joining us right now, who helps to lead our CFO newsletter. And I think you've probably been a busy person over the last few weeks here because we've had a lot of transitions in that CFO space here. What's been driving that?
Yeah, I think you're right. We've had quite a few changes, and we've all, of course, been wondering what's driving it. Yeah. I think Chris Calder pointed out there's a few factors looking at turnover that is increasing, as well as then tenure that's getting shorter, as well as the amount of external versus internal appointments that we've seen. And I think combined, they all point to this darkening economic environment where companies are willing to say, okay, well, what's working and what isn't, and the setup that we currently have probably isn't, which is why we've seen an increase in changes, even though also the summer months is often when CFO changes happen because there's always a bit of seasonality to it. If you're seeing that your year isn't going too well, then you might also say, okay, well, let's change now, rather than to say, okay, let's drag it into the second half of the year where you can't really change the narrative of the year as a company.
What are the metrics that CFO recruiters are relying on? I mean, I imagine stock price is definitely one of them because the CFO would be more responsible for that than perhaps other C-suite positions. But what else are they looking at?
So for recruiters, I think probably the most interesting metrics are turnover, as in how many changes do you have in the first place, and then also how much do you hire from the inside versus the outside.
Oh, okay.
And also then how long are people staying. And I think whilst turnover is up and external hires are up, the tenure is down. And so that tells us that people are looking more to the outside, and they're also getting rid of their CFOs more often, which happens more in times where you have an economy that isn't doing too great and where companies are, as you said, looking at their share prices and they're saying, okay, well, this isn't what we want to tell investors going forward.
Is this also partly a testament to just how much that role has changed? I mean, we have a special program that we do on Bloomberg called Chief Future Officer, a play off the CFO title, which is more kind of a nod to the idea that they're more than just bean counters and accountants the way that we used to think of them back in the day. But I also think that means that the skill set has to be broader, which also means that it's probably a tougher job and harder to find the right person.
That's fair, and that's true. Yeah. Of course, we have seen that shift in CFOs in terms of what they're doing. You pointed it out, less so bean counters and more strategic. We have seen an increase in CFOs that turn to become CEOs. We've also seen shifts towards more operations, so shifts towards the chief operating officer role. But I think also it's testament to the fact that the economy is changing, and therefore companies are saying, okay, well, I used to have a growth-focused CFO and who helped help me grow my business and who was more focused on doing that. And now companies are saying, well, the economy is changing and therefore I need somebody who is willing to wield the axe. And of course, not surprisingly, you would be more open to finding an external person who is doing that because they have not necessarily the same sort of strong ties to certain divisions, certain people, and might just be willing to be a bit more aggressive in cost cutting.
It's not just the economy that's changing as well. Politically, we might get a big change, and so that might mean a change in policy too. How do you see the election impacting these searches?
Yeah, it's a good point. It's something that sort of basically continues what we've seen recently when we had a survey that was saying, okay, a third of CFOs are delaying investment decisions. And now we're also hearing from recruiters saying, well, actually, looking at the two candidates and the different policies that are being proposed, let's wait if we can with making a CFO appointment, given that sort of depending on who wins the election, you might see big changes in tax, or you might not. We don't necessarily know yet, but sort of depending on who wins, if you have the time and you don't necessarily have to appoint somebody right now, you might want to sort of appoint an interim CFO and say, okay, I'm going to do my search, I'm going to look at the candidates, and I'm going to only make an appointment once November, the election on November 5th is over.
Buy some time, in other words.
Right, buy some time, just because, of course, it can make a huge difference if you have sort of a tax specialist being one of your candidates, and then on the other side you have somebody who is more experienced in navigating trade tensions, just to name two of the sort of scenarios that we might see that could make a difference.
Two of many scenarios. Nina Trentmann, thank you so much. Nina Trentmann with her coverage on CFOs. She has a newsletter on that, of course. Coming up, we've got the top three, where we focus in on some top three movers and shakers at the center of the day's big stories. This is The Close.
Season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Derica Hamby, the WNBA player suing the league and her former team, the Las Vegas Aces, alleging pregnancy bias. Romaine, she had signed a 2-year contract extension with the Aces, and a month later she discovered she was pregnant. She told the team, and later on they basically traded her to LA, and she said the coach accused her of signing the extension while knowingly pregnant and not taking proper precautions to avoid pregnancy.
Yeah, definitely a case we're going to be following. Remember, this is actually the first time the WNBA has found themselves the subject of allegations regarding some of their players who were pregnant and going to motherhood there. Also keeping an eye on, remember Marko Kolanovic? Of
course.
Yeah, he was over at JP Morgan. Of course, he was the chief market strategist there. He left the firm back in July. He was there for like 20 years. Didn't really give an explanation. Of course, he had a lot of bad calls. He had that kind of disastrous call back in 2022, and then he flipped to bullish right at the wrong time, and then back to bearish again here over the place. He's resurfaced now. A post today coming out on both LinkedIn and on the platform formerly known as Twitter. Basically, just kind of talking about random stuff here. I don't know if he's found a new job yet here, but he certainly feels like he needs to weigh in here on some of the potential election risks.
I like his handle, Marco in New York, so that suggests he is not working with a firm right now, but he does cite a bunch of risks for the market, so he hasn't changed his view in terms of being bearish at this point.
No, and I mean, somebody will pick him up. I mean, obviously, he was a big deal. He had a couple years of bad calls, but is there a strategist on Wall Street that doesn't go through that?
Yeah, and I like the way people put it, which is once a bearish analyst loses his job, that's the sign of the top of the market.
Yes, absolutely.
So, our third person, by the way, is Anna Wintour, or Anna Wintour. I'm not sure how you say it. I'm not fashionable enough, but the Vogue editor-in-chief is set to host a fundraiser.
I think it's Mrs. Wintour to you.
Oh, Mrs. Wintour, excuse me. Okay. The Vogue editor-in-chief set to host a fundraiser for Kamala Harris over Labor Day weekend. Where else? In the Hamptons. Tickets for the event start at $2,500. They go to $50,000.
$2,500. That's quite a bargain. Now she does this a lot. I feel like every election cycle we hear about her holding a fundraiser for whoever the Democratic candidate is. I know she was close friends with Hillary Clinton, and I know she did some stuff for the Obama campaign back in the day. So this seems kind of par for the course for her. Does she still have that kind of cachet?
I'm sure she does among the people who would be giving money, yes.
Right, all the only people that matter, right?
Yeah, maybe not Gen Z necessarily, but I don't know if Gen Z watches or reads Vogue.
Yeah,
they watch TikTok, right?
Yeah, I don't know. You're asking the wrong guy here. I never read Vogue, but good kudos to her here as we move deeper into the election season. And well, guess who's resurfaced? The former president of the United States, Barack Obama. He's out not with a political commentary, but with his summer playlist. Scarlett, I know you follow this intently here. It's always a great to sort of read the tea leaves of what he's listening to. A mix of old and new includes Whiskey from Moneybagg Yo, as well as like big classics here by Bob Dylan, like Silvio, and The People by Common, which kind of surprised me. Although Chicago artist.
You said he doesn't have political statement here. He does have Charlie XCX, who, it's supposed to be a brat summer. So, you could make the link there. But, he's got old school names and current names, right? He's got Norah Jones, but Tupac Shakur, Etta James, Megan Thee Stallion. So a little bit of everything from the former president. Yeah, and normally I don't really quibble too much with this list, but for reasons that I really can't explain, he put No Diggity on here from Blackstreet. It's a classic.
I don't think I'm going to vote for him in this election cycle. All right, when we return, we're going to take a look back at the Ronald Reagan tax cuts of 1981. Let's look back in history. On this day, back in 1981, U.S. President Ronald Reagan signed into law the 185-page Economic Recovery Tax Act. It was a historic package of budget reductions, but it was most notable for cutting the amount that you pay on your income by 25% across the board. The bill, still the largest tax cut as a percent of GDP in the post-Civil War era, not only fundamentally changed tax policy, but it critically reshaped political ideology around taxation for decades to come. While proponents argued the tax cuts helped spur economic growth, opponents complained the cuts overwhelmingly favored wealthy Americans and starved the government of revenue. Now, that is technically true, but look at it this way. The Tax Act Reagan signed initially cut the top rate on unearned income to 50%. But of the 95 million taxpayers who filed that year, the reduction, it applied to just 82,000 of them. That's according to the Center for Public Integrity. So it was lopsided. Now, to be fair, though, tax rates 40 years ago were astronomical, as much as 70% on the top end back in 1980. And you add in double-digit inflation that was pushing a lot of Americans into higher tax brackets, even as their real earnings stagnated. So you get where the concern was. Now, the Tax Act that Reagan signed, it changed the narrative big time, and it led to a multi-decade effort in Washington to ease that tax burden for income earners as well as businesses alike. Subsequent cuts over the decades would push the overall top income tax rate down further, with 7 brackets now in effect today, ranging from 10% at minimum and 37% at maximum, a long way from 70%. And while the Reagan tax cuts did boost GDP, they also led to big government revenue shortfalls. And that brings us to a weird quirk in the tax-cutting narrative that has defined Ronald Reagan's legacy. Because of those budgetary issues, Reagan subsequently raised taxes 11 times after 1981, beginning with the Tax Equity and Fiscal Responsibility Act of 1982. By the time he left office, more than half of the tax cuts that he had signed into law in 81 had been rolled back by his very same signature. Scarlett?
I love that. Part 2 of the story of Reagan that no one ever really talks about. All right, we want to bring you some breaking news here. The Department of Justice is considering asking for a Google breakup, a breakup of Alphabet's Google after the landmark antitrust win in which a court ruling found Alphabet had monopolized the online search market. This is according to people familiar with the matter. So right now, this is not a decision that's been made already. They're just thinking about it. They're reviewing Google remedy options, and a ban on exclusive contracts is also one of the things under consideration by the DOJ. Romain, you can see the shares of Alphabet right now trading lower by 1.5%.
Yeah, I mean, this is certainly significant and obviously material, if you will. The question is, how does this actually play out, Scarlett? I think we have both been in this business long enough where we remember the Microsoft antitrust case. And look, Microsoft lost that. But did they really? Because they're a much bigger company today than they ever were prior to that case.
They lost for a couple of years, and then they came roaring back.
Exactly.
Okay, let's talk about some of the businesses that companies like Microsoft and Alphabet used to be, small businesses. And the latest data show that U.S. small businesses were feeling more optimistic in the month of July. The National Federation of Independent Businesses Optimism Index rose for a fourth straight month. Even so, the group's uncertainty index also reached the highest since the depth of the pandemic, which really highlights the challenges of navigating the macro environment and, of course, inflation. So joining us now for more is Holly Wade. She is executive director of the NFIB Research Center. Holly, I mentioned inflation. It feels like inflation is a big factor, but is it more of a correlation or a causation here?
Well, it's certainly a big factor. Right now, 25%, 1 in 4 small business owners in our monthly survey are saying that it is their single most important problem in operating their business. Thankfully, fewer are feeling the pressure to increase their prices or have increased their prices in the last 3 months. So we're seeing a bit of easing in that department, and also related to compensation, which is a huge factor in their increasing cost inputs. The last survey from July did show that fewer are saying that they're planning to increase compensation in the next 3 months, even though we're still at very high levels.
Okay, so that's on the cost side, the inflation side. We also mentioned uncertainty reaching the highest since the pandemic. What in particular are these businesses concerned about when it comes to uncertainty? What are they not getting clarity on?
Sure. Well, there are many areas of the economic conditions that are unclear for them. One is government regulations and taxes, what that looks like for them in the next year or two, but also related to, lowering interest rates and what the Federal Reserve is going to do in the next few months if the cost of financing might start to ease up a bit for them. But then also just a lot of talk about whether we're heading into a recession, whether it's a soft landing or a hard landing. And all of this is of a lot of concern and entails a lot of stress on small business owners in how they operate their business going forward.
Was there any sense from the study, Holly, that they expect any of these pressures to ease, particularly when it comes to some of the stuff coming out of Washington with regards to taxation and regulatory constraints?
Well, certainly the last 4 years have been difficult for a lot of small business owners, whether it's on a federal level or in their states, dealing with and trying to figure out the regulatory complexities that they might have to comply with. And then on the tax front, we have a lot of those Tax Cut and Jobs Act provisions that are particularly were beneficial for small business owners that are going to expire in about 1.5 years. And so that potential tax increase is of concern to small business owners in how they're going to absorb those costs going forward. They've had to absorb a lot of costs over the last few years as far as inflation, whether it's their supplies or inventory in operating their business. And this could potentially be another hit for increasing costs in operating their business. But, Congress can do something about that and help them out.
I won't hold my breath on Congress doing anything, Holly, but I like your optimism there. Look, I'm sure you know this, Holly. I mean, the market pays close attention to the NFIB data and, of course, these longer-term reports because they're really trying to get a read on economic conditions, and small businesses have always, for a lot of folks, been kind of that canary in the coal mine. I want to zero in on one thing that was in that sort of priorities report, and it was the drop in rankings of companies that said they were having trouble locating qualified employees. Now, on one hand, that's good for them. On the other hand, if you're a market participant looking at that, that might signal that maybe the labor market is starting to, get a little bit soft. Am I reading too much into that?
So it's still at very high levels, the percent of small business owners saying that they have an unfilled job opening currently. It has declined off its peak from a couple years ago. But again, we've been doing this survey for 50 years, and we're still at unprecedented levels for that question. So while it is easing and it does appear that the labor market is softening up, even for the small business sector, it is a priority for many of them to fill those open positions, to maximize their sales potential and working with their customers. So it is certainly a tight labor market for some, and especially in certain industries, construction, transportation. Those are two where almost half of small business owners are saying that they're still looking to fill open positions and recruiting applicants.
All right, Holly, going to have to leave it there. Appreciate you taking time for us. Holly Wade, she's over at the National Federation of Independent Business Research Center here. A closer look here at the heart of our economy, which of course is small business. We do want to get back to that breaking news on Alphabet. We did learn here that there is a rare bid to break up Alphabet's Google as one of the options that the Justice Department is considering. This comes after that landmark court ruling found that the company monopolized the online search market. Anna Edgerton joining us right now from our Seattle bureau has been writing about this story. And Anna, it's kind of confusing because I know there's a lot of different cases circling Alphabet right now. Which case is this specifically, and how much do we know about the Justice Department's efforts at remedy?
You're absolutely right. And there's kind of two things that I'm looking at right now. The first is the timing of this, which gets to your second question, because we do expect Google to appeal that underlying liability ruling. If they're allowed to appeal before they go to the remedy trial, then it could be as much as a year or two before we get to this actual discussion. If that appeal is left until after the remedy discussion, then we expect to see a proposal from the Justice Department much sooner. So one thing that we're watching is the timing. The second thing that you also mentioned is the number of complaints facing Google right now. This is a case that was filed during the Trump administration that has just gone to trial. So if there's not a structural remedy that's actually achieved in this case, there could be another chance for the Justice Department to seek a structural remedy in the next case, which has to do with Google's ad tech business. So like you said, definitely a few things facing Google right now, and a few opportunities for the Justice Department to look at Google's underlying business model.
And again, this is based on your reporting so far, so I'm curious to hear what specific remedies are under consideration, or at least being bandied about as possibilities here.
Yeah, the one that I think is most likely to be included from the people that we spoke with is prohibition on the kind of agreements that gave Google the dominance in this market. So specifically, that's Google paying mobile device makers to make their search product the default on these mobile devices. We do expect the judge to put a ban on that kind of practice for Google, as it was found to be a monopolist. And then going from there, it'll really be up to the judge whether he wants to include these structural remedies, maybe forcing Google to divest the Android operating system and the Chrome browser. Those are two of the suggestions that we had heard from people with knowledge of this case. So that's something that the Justice Department is weighing right now. Also, how severe is their proposal in the remedy, and how much they want to be negotiating with the judge on this.
All right, great stuff. Anna Edgerton leading the reporting here on the Department of Justice, looking into thinking about asking for a breakup of Google, of Alphabet, after its landmark antitrust win. In the meantime, if you look at how markets fared on the day, Google did close higher in the regular trade, as did the Mag 7 names, as did the S&P 500. In fact, closing at session highs. Both stocks and bonds gained as investors are happily anticipating the CPI report after the wholesale inflation numbers came in cooler than expected.
I don't know, though. We were talking to Stuart Paul over at Bloomberg Economics earlier today. He actually thinks that maybe what we saw today out of the PPI report might be a bit of a head fake. He kind of had an explanation that I couldn't repeat because I have no idea what he was saying. But he talked about this idea that tomorrow's CPI report might let a lot of people down.
All right. Well, we'll see how that shakes out. Yeah. But in the meantime, you do have equity assets, equity and risk assets doing very well on the day. This is The Close on Bloomberg. Fresh inflation data due out tomorrow, with U.S. CPI coming out at 8:30 a.m. Eastern Time. Veronica Clark and the team at Citi writing, we see a number of reasons to expect further softening in inflation, including a long-awaited slowing in shelter, a loosening labor market. Veronica joins us now. Veronica, we got a pretty decent PPI report that showed cooling inflation. Is there reason to believe that, that's going to lead to a good CPI report? Because the market, at least, seems to think so.
Yeah. There's not always a whole lot of read-through from PPI and CPI month to month, but I think the trends in the PPI data that we saw this morning just bode well for further easing in inflation broadly. We are expecting a relatively benign CPI reading tomorrow, a 0.2% month-on-month for that core number. This will be, I think, more data that will be encouraging for the Fed.
One thing that was certainly encouraging from the PPI report was the first decline in services costs this year, which sounds significant. Is that going to be something we see echoed in CPI?
Yeah, there was some volatility in certain components of the PPI data, particularly trade services. We actually kind of look through that when we're looking at underlying trends, even in services PPI. But I think we will probably see some softness in services and CPI tomorrow. One really important component will be what happens with shelter inflation. That's been a really sticky component of services. It's a very large component of CPI and PCE inflation. And as of the last data for June, we finally saw that slowing, looking a lot more normal. It does tend to be pretty sticky month to month, so would expect that slowing continues in July. And broadly, we do know that maybe some demand for certain services like travel is easing. Wage pressures do seem to be easing with a loosening labor market. So a lot of reasons to think that there are downside risks. There's slowing inflation now.
Is there any sort of potential for that upside risk, Veronica? We were talking about a little bit earlier in this program about how lopsided the trade has gotten around this here. And of course, once we got the PPI report, it got even more lopsided. Everyone right now is positioned for that disinflationary story to continue and for it to continue in a way that's going to lead to Fed rate cuts.
Yeah, no, absolutely. Even though there are more reasons to think that inflation would be slowing, it does seem like the asymmetric risk for the market, or maybe if we do happen to get a stronger reading, which never say never. There's always ways that you can get something like that. Maybe some volatility in components like airfares, which were very weak in June. We have seen some rising shipping costs, elevated shipping costs. We haven't exactly seen that passed on to consumer goods prices. I think the consumer is really pushing back on any more price increases. But those are some underlying upside risk potentially. Things like used car prices, wholesale values seem to be rising again. Maybe that's a risk as we're getting into the fall.
With regards to disinflation on specific categories and products, and let's just stick on the consumer side for a second, because we've spoken so much about how we've gotten at least anecdotal evidence of the consumer pulling back, and maybe those retail sales numbers on Thursday will confirm that. But is there anything that we're seeing in these CPI reports and as well as these PCE reports with regards to that disinflation that would be a net positive for boosting consumer spending?
Yeah, I mean, we've seen the pullback in spending pretty consistently throughout this year in the more discretionary items. Certainly, we see that in restaurant sales. We've actually even seen some stickiness to restaurant prices, though. But it does seem like it's been a number of months now where some of those input costs, high shipping costs, have come up, and that hasn't been passed on even in some of the PPI data. So it does seem like that ability to pass on price increases is pretty muted, and that hasn't been happening. Prices have been more subdued for most of this year, and still spending is pulling back. So it does feel like maybe even some of these softer prices are not exactly boosting consumption.
How cool would this CPI report need to be to cement the expectation that the Fed will cut in September, and 50 points at that?
Yeah, I don't think it's necessarily going to be the inflation data that solidify a larger 50 basis point cut, but certainly I would think if we're getting a 0.2% month on month core CPI like we expect, core PCE will be pretty favorable. I think then that's 3-4 months of much more favorable inflation data. It kind of opens the way for Fed officials to say that they've gotten more confidence. Clearly they couldn't say that as of the July meeting. Otherwise, they probably would have been cutting rates at that July meeting a couple weeks ago. And it certainly opens the door to focus a lot more on the weakening labor market, potentially weakening activity. So I do think that at least is a 25 basis point cut. We do think that they're cutting 50 in September, though, on that weaker labor market story.
Okay, and notable, by the way, that there are no Fed officials due to speak tomorrow, even after the CPI report. I know it's nothing on the calendar until the 15th at 9:10 a.m. So, and that'll be after the retail sales report. Veronica, what are you thinking in terms of retail sales? I know we're still 2 days out from that, but it's something that is definitely top of mind given the earnings reports we've heard from all kinds of companies saying that consumer spending seems to be, slowing down.
Yeah, no, absolutely. I think if we get past, CPI tomorrow and it's relatively benign, retail sales, initial jobless claims at the same time as retail sales, that could really be the most important data this week. We are expecting to see a somewhat, more modest reading, especially in that retail sales control group sales. That's really the maybe core retail sales. You have the best read on underlying demand, and that was really strong in June. Would expect that is softer, something like a 0.1% month-on-month increase in July, and I would say that, the risks are probably more skewed to the downside.
This gets to a broader question, too, and I know you're an economist, so you have to sort of look at the data, but we talk about, I guess, the feelings, the vibes, if you will, in the economy. And at least if you go by what we're hearing on these conference calls, the idea here that consumers, whether it's true or not, they just don't really feel like we're in a good economy right now. How much does that sort of drive the data, or is it the data that's driving the narrative?
Yeah, I mean, all of it matters, of course. Usually something like, a consumer sentiment index, it's going to be very influenced by, price levels. And I think people feel, bad about the economy because, even if inflation has slowed, the price level is still maybe uncomfortably high. And that can, impact how people spend. We do have, maybe survey data, especially on how consumers perceive the labor market. Elements like the labor market differential in the Conference Board survey, that's been coming down, basically people feeling worse about employment prospects. And so if you're already feeling bad about high prices and you're feeling worse about your employment prospects, it would make sense that spending would pull back. And I think that's probably been a reason why we've seen softer spending this year.
All right, Veronica, great stuff. Going to have to leave it there. Veronica Clark, economist over at Citi, on a day where we got a surprise cooling in that PPI data, CPI data on deck tomorrow morning. We're going to set you up for some of the other potential market moving events. Stick with us. This is Bloomberg. All right, here are some of the potentially market-moving events over the next 24 hours, and we start off with earnings. We get quite a few tomorrow, believe it or not, Scarlett. I thought earnings season was over.
No, never.
Yeah.
It's never over, as we've discussed. UBS will be reporting, and certainly the wealth management division will be a big deal, but also how its non-core legacy unit is slowly being wound down. And then here stateside, we continue to get tech earnings. I feel like this is the last of the tech companies before NVIDIA.
Well,
Cisco.
we got NVIDIA, too.
Well, I know, that's a big one.
In about a week's time here. All right, Cisco is after the bell tomorrow. We'll have full coverage of that as it breaks. Overnight, though, we are going to get some inflation data out of the United Kingdom. Yeah,
CPI numbers will be coming out. And in terms of a year-over-year basis, we're looking at a 2.3% estimate for the month of July. When you strip out food and energy, it's going to be a 3.4% increase.
All right, and then back here in the United States, a number that we don't always keep an eye on, but those weekly mortgage applications, which actually might be a little bit more relevant given the drop that we've seen in Treasury rates.
Certainly. We haven't seen that many mortgage applications come in because mortgage rates have been stubbornly high, but maybe that will change this time around. And of course, the big one.
Yes, we get the Consumer Price Index here in the United States tomorrow, 8:30 a.m. Eastern Time. Scarlett, are we going to get another pleasant surprise like we got this morning?
I don't know. That's what the market's priced again. So if we don't, you're going to see quite the reaction.
I know. I really want to see the over-under on that here. Of course, Team Surveillance will have full coverage of that CPI report, 8:30 a.m. Washington time. But stick around. Balance of Power is coming up next, right here on Bloomberg.